Well, we made it to Friday. Kind of a little bit of disappointment. All right, so one of the big things that we were looking for was guidance from Japan. And I know that kind of got lost in the shuffle with everything that's going on. And I haven't had a chance to go through whether or not they proposed a new prime minister, but we were going to get data out of Japan in the overnight. And then we also have PAL today. And that kind of a combo punch was supposed to keep the market in a relatively sideways range while we waited on these big data points. And if you were around yesterday, you noticed we didn't do that. Number of reasons. We got some job numbers yesterday. Remember, I mentioned yesterday morning that the job numbers go to the heart of what the Fed has been doing. And it really kicked off this whole selling that we had, taking it back into July and August. So we got numbers yesterday, a little bit of a spike to the upside into liquidity, right into that sell zone that we had drawn across the top of the ES. And then down we went. We also had the 30-year yesterday. And now we're right back inside the zone. We are right back where we were. We do all that running around and feel like it's all about to unwind, but we are right back where we were Tuesday and where we've been all week. And that's the idea of a sideways market, is that we're not supposed to go anywhere. We're supposed to hold the range. And so you pop out one side and you pop out the other side, but at the end of the day, you're just right back where you were. Right. And that's exactly what we got. Like a hamster on a wheel, a whole lot of running to end up right back where you started. So the NASDAQ up 0.75%. Hong Kong basically flat. Japan up 1/4. I mean, you got to at least appreciate. And small caps are up 0.5%. Really going to keep my eye on those in the next few days. You know, there's been this talk about when small caps coming back. And I think maybe there was an early start, you know, and a lot of people piled in, and then there was some disappointment, a little bit of buyer's remorse. It's too quick, too soon, right? It's going to take time with those small caps. And that's if we get any real love out of them at all. I have heard some pretty good numbers for small caps, you know, like take IWM instead of the rut at more of around $300. You know, that's a wild number to hear. It's not going to make it there in a month. We hope. Powell is not the only Fed speaker today. I know he's the biggest one on the table, but we have Bostic, Harker, Goolsby, Bailey. Of course, that's almost into power hour in the later part of the day, and it's not for US, but it's still another speaker to be concerned about. It's going to be like that all day. There's going to be something in our face. So, you know, like yesterday, things were spread out really nice. We had job numbers first thing in the morning, and then we were pretty good into 10 o'clock and then 1 o'clock. Today, look at it. It's every hour we've got something coming at us. So just, you know, take it easy, one step at a time. We've seen some real violent shenanigans this week. The miss at BLM, we were supposed to get those numbers at 10, and then they came out with some junk at like 15 after, way late, and the wrong data. And then they finally came out with the data really close to 10:30, and there was that massive move up, the big old sell off, the run back up from that, just that one day. It's been wild all week. It very likely could be wild today, especially if he does a really good job of talking for 30 minutes and saying absolutely nothing useful. And that's what he's going to try to do today. I don't envy the guy, you know, trying to talk without saying anything. There is a slight worry that he may actually try to shock the market. He did it before. He's got his own soapbox, so to speak. And he could use this opportunity to really get a message across in a forum that is more open than the restrictive forum that he has to use when he's doing his FOMC announcements. We'll see if he can thread the needle. If he does, and he gets away with really saying nothing and doesn't really offer any guidance beyond what the market already has, then I think our range is set. Yesterday did a really good job of giving us the plus and the minus. And that we'll go into the close maintaining within the range that we built yesterday. They are hedging this morning on low volume. That's exactly what we would want to see. You know, remember recently when we have found them hedging, it's been done with some relatively high volume, twice this size. And then it's weird because there shouldn't be volume and hedging. But today it's just good old fashioned, nice, clean hedging on really low volume. It's exactly what we want to see. They are hedging in front of this event because they're concerned and it's a really big unknown. And this isn't my opinion. I'm not speculating or guessing that they're hedging. They're hedging. We know this for a fact. I have the cute little label up there that says it, but if you don't have the label, you come into the ES futures and it's right here across the top. There's the market maker move signal. Now, it's not something that you have to turn on. If you go to a different product, say, I don't know, Google or Apple or something, and you don't see it there, it's not because you haven't turned it on. It's just if there isn't a market maker move, then it won't be there. If there is one, then it will be there. I think this is a feature that they need to change, and I've told them that. They don't listen to me. Seems like everything's got a market maker move today. But that's where it would be. That space would be empty if there wasn't a market maker move. But there is a market maker move. And on the futures, it shows us that they're hedging. Now, what this market maker move does is it looks at the front expiring options and it compares that with the next options expiry down. So look at the 0-day today, it's at 1733. Look at the next one out, it's at 12. So the front expiration, the 0-day, has more implied volatility average than the next one out. And when this situation happens, we get a market maker move. I've heard a lot of really popular, famous people talk about the market maker move and get it all wrong. They say the craziest stuff that isn't true. You want to know more about this indicator? There used to be a website called the Ticker Tape by TD Ameritrade. Now, if you search for the market maker move on Ticker Tape, you'll end up at a Schwab website. And it looks like they tried to condense maybe 8 different market maker move articles into just one article, but there is an article there. And it explains what this thing is by the people who created it, right? So rather than hearing it get all jacked up from somebody who thought they knew what they were doing and was just completely wrong, or even me with a limited time, not giving you all of the information about a market maker move, Google that market maker move TD Ameritrade or market maker move ticker tape. You'll find the article on it and you can read more about it. Just for a tip, they don't mention futures. They don't even bring it up. I had to figure out that part of it all on my own, but they explain what it is and how it's working. So we know that they're hedging because the implied volatility average has risen higher than the next one out. The way that this number moves is by these out of the money options. Implied volatility on a candle chart looks at the candle close to candle close, the movement between each candle and how far it went way before it closed. Well, how do you do implied volatility here? These are options, right? So even if you do go in and you turn on the implied volatility, what makes the implied volatility on an options price change? It's trading. So trading activity within the option strike itself is what changes the implied volatility of that option strike. That's not the only thing, but that's a big piece of it. How many trades have come through? How far apart were they when they came through? So the pace of the tape, the aggressiveness of the trades, are they all hitting near the mid? Are they hitting at the ask, at the bid? And those activities within that particular options strike is what changes that strike's implied vol. They average all of the implied vol for all of the out of the money options, and they give it to you up here. So that's the implied vol average for this expiration. When they're hedging their SPX positions or their SPY positions, they'll do it here. That's what they're using the futures for. And they'll do it in the front end, which jacks the implied vol in the front end higher than the next expiration out. And dun da da da, there you go. You got a market maker move. So it's not my opinion. They're hedging. They're worried. They're concerned. And unlike retail traders, when they hedge, it's just cost. It's not a speculative trade. It's not a possible way to make a little bit of money. It's just straight up throwing money in the fire. They're not going to spend that money if they don't have to, right? You don't buy insurance for fun. You buy it because you need it. We are closer to the upper edge of the inside ADR, the ADR half. Unfortunately, that's not going to help us if we can't get there before all of this, all these events start hitting. So typically, if we're closer to one side than the other, we point to it and say, yeah, we're probably going to go ahead and get to that one side. Right now, everything's on pause until we get through Powell, at least. Now, we can move before him if some other data comes out, or even just some, random news, something bad that nobody was expecting, a plane crash or a boat sinking, right? There's always something that can move the market. But otherwise, we're just going to be waiting on Powell. So the ADR lines today are going to be useful after Powell. How much farther could we go? How much does he juice the market in one direction or another? And the market has already priced in a rate cut, whether it's a 25 basis point or a 50 basis point, they've priced it in. And if he implies in some way that we're not going to get that cut, or it won't be as big as what's been priced in, then we're going to see the market unwind some of that. Remember, they're going to use a rate cut as a way to lessen the restrictions that they put on, right? They're easing liquidity, so to speak. And the market reacted as if we already had that cut. That's what it means by pricing it in. They've already done the work of what a cut would do had the Fed already cut at the last one. If they take that away and we have to unwind it, could see some pretty good size moves today. It is encouraging, though, to see the market maker move. The fastest moves, when you get something like one-time framing, single directional massive push, these big moves come from surprise. When they think it's going to be one thing and it's something else, when they weren't ready for it and they weren't hedged And now they're all scrambling to buy all at once. Or if this was a red bar, they were all scrambling to sell all at once. But if you're hedged, you don't care. If it goes up, you're good. You don't care. Goes down, whatever, you don't care. So we could still get the initial drive in one direction or another, the big spike, the big drop, but we would expect it to immediately turn back around again because it's hedged. Like a liquidity gap getting closed. The gap gets closed and then the market reevaluates and decides, did it really like that initial drive? Say it went to the upside, it falls back down, closes the gap. It can then go back to the upside again, right? Or it falls and jumps back up to close the gap and then continues to fall afterwards. Don't get too married to the idea that it's going to be a bullish day or a bearish day after we're done with Powell, because we've still got a lot of other events on the table. The 21-day average daily range is 96 points. Our daily expected move is 46 points. We're still double the daily expected move. A daily one standard deviation is at 55 points. We're not quite double that, but we're still nearly double that. So that's a definition of volatility there. We're moving a lot farther than we should be moving. Central pivots. Today's channel is lower than the previous day's channel. It's completely outside the range, and it's much wider than yesterday's channel. Price also opened underneath that channel. All of that is bearish. The fact that the channel is lower, the fact that we opened underneath that channel, those are both bearish conditions, bearish bias. Now, we came back through it. Yay. That doesn't get us very far because we're supposed to hit the pivot anyways, and we got a little bit of juice out of Japan, and it didn't stick, right? It got us a little bit. Got us a little bit, but it's already, I mean, look at Europe. It's just not holding, right? We're kind of just hanging out, waiting. We have a classic D shape right now in our own current week's profile, and we're at the point of control. It's also nearly the halfback, and we got to measure it to see exactly where that halfback is, but that's pretty close to the halfback. We could be looking at a halfback rejection. Just keep in mind that when it comes to violence and economic news and speeches by Powell and things like that, pivot points won't stop price if it's a reaction to a statement or economic news or anything like that. Even a halfback will get run right the hell over. So it's not something to lean on once we start getting data. For a downside move, 55.70 is last week's weekly point of control. 55.64 area, right around there. We would expect it to slow down a little bit if we hit that, like a speed bump. Maybe we pause there, digest it a little bit, and then continue to move to the downside, which would make sense anyways, because that's a pivot point. And if we did come down and hit that, then we would be looking at a potential double bottom, and double bottom's a bear trap. But to convince the bears that we're actually going down, we would need to break that pivot and go a little bit lower first, which would get us right into that point of control. We still have the one overhead, 56.92 cog line. It's really close to the cog line, so we're better off just using that. The spot gammas report yesterday or last night's, I think they did a really good job of laying out the signals that they saw yesterday. They had 3 different chart examples and pointed out the options flow yesterday and how it continued to signal that sell-off, and these attempts to run it back up and how they failed and what it looked like in the options. They had charts with pictures and arrows pointing exactly to what they were talking about. If you didn't read it yet, it's really worth a read. Now, I get it. If you don't have spot gamma, you can't see those charts intraday, but a lot of times, you know, I'll post an update of what they're looking at or what I see on their charts. And you can always just hit me up and ask, hey, what does the flow look like? And just grab a screenshot, you know, and send it your way. We don't have the AM one yet. Once we get it, I'll pass it out. I'm pretty sure they're waiting. They're going to wait as long as they can before they send it out today. We have the 10-day underneath this volatility trigger, 0 gamma, the 3-week, and the lower ADR all underneath this stacked up ready. We have the round number 5,600, the cog line at 5,611, another cog line at 5,592. So we've got a lot of structure down below. And the call wall 5772, that's a long ways off, right? We'd have to get through the entire ADR and then do another ADR above that. Could we do it? I mean, yeah, price can do whatever it wants, right? That's a 200-point move. That's nothing. Maybe it's just 100. Yeah. Yeah, 150 points. We can do that. But are we likely? No, it's not likely that we're going to do that, but it is possible to do that. During COVID, we were moving more than 7% and triggering lock limits. So what's 1.5%, right? Well, we got our downside range now. As long as we're staying within this range, this point of control will not act as a support or resistance level. But if we leave this range and then we come back to this point of control, it will act as a support or resistance, depending on if we're above it or below it. Right now, we should be able to pass through it even right now, as easily as we did yesterday, and as easily as we did back here earlier in the week. There's nothing else that could get a point of control at this point, because obviously we're hanging out where it is. If we fall down from here, it would take days to move it down to this 55, 65 area, and probably weeks if we were down in the 54, 50 area. So it is a resistance from the idea that it's structure and we're right there. It's a part of a topping pattern. But if we expand above it and get out of this box that I have here, and then we revisit this zone, it's very likely going to act as a support level. It's interesting to note that the TPO has not brought the point of control up. These are 2 different profiles, not just because the pretty colors, but the one in green is a volume profile and the one in blue is a TPO profile. Time, price, opportunity, TPO. The most basic description difference between these two is volume by time versus volume by price, right? So the way I like to explain it to people is the one in green is looking at how much volume happened at that particular strike price, say 56.25, versus how many trades took place at that strike price, say 56.25. Usually we see the point of controls match. When they don't, it implies that there was large trades taking place, right? Instead of a bunch of 5-lot trades, that we were hitting 500 lot trades. One trade, 500 lots, as opposed to, 10 trades with 10 lots, that sort of thing. So when they match, it's just a bunch of small trades or trades that are, equal in size. If it is mismatched, then it's implying that we hit this massive liquidity zone where a lot of big trades were sitting there. We see it at ceilings and at bottoms, what we call icebergs and ceilings. So we hit a ceiling. We hit a bunch of liquidity up here. And we still haven't brought that TPO up. Five-day, 5-minute chart. We call this the 5x5. I get it. For those of you who don't have Thinkorswim, you don't have this default setting. But on Thinkorswim, if you was to open it for the first time, you've never used it before, one of your chart time frames would be 5-day, 5-minute. It's just a default chart setting. So it's what we call it, right? The 5x5 chart. I've got more than 5 days loaded. If you're on TradingView, it doesn't even care how many days you have loaded, right? You can just zoom out as far as you want, scroll back. There's no magic to 5 days. It's just a nice little naming gimmick. But we can see the profile of yesterday, and we ran over this one from Monday, this 5,600. So we're just going to use that one since it's no longer valid. And that is our VPOC from yesterday. And it's pretty much in the same spot, 5,600, 55.97. It's close enough. It'll do. 5,600 is a pivot point. It's a round number. Liquidity resides on the other side, even just by a couple of points. So it's perfect. It's exactly where we would expect it to be. Now, there's no magic to this. It's the point of control of yesterday without giving any bias at all, bullish, bearish, whatever. If price comes down into this level, we're going to expect to see a lot of trading activity. You can call that support if you want to. But I think we would both agree that if that's where the greatest amount of trading took place yesterday, then if we revisit that, there's very likely going to be some trader's remorse, right? Some unfinished business, and that we'll see trading activity heavy at that spot again. And that can become support, but it doesn't have to be. It's definitely an area of interest. Since it's Friday, we have next week's levels already. Now, these aren't set in stone yet. This is just a projection of what it could be. After the close today, about 4:15, they'll lock into place, and then they won't move anymore. But for right now, they're still alive. They're still moving. The gray line is our current price, and the green line and the red line are a measured distance away from that. And so when price itself is moving up and down, so is that gray line, and that forces the red and green line to move. And it's going to continue to move all day until the close. How wide this is based on volatility, and the volatility that we're measuring comes from in here. So it's looking at next Friday's expiration, and it's using this plus and minus. At least that's what it's supposed to measure. Just a little tip, Thinkorswim doesn't allow you to code indicators that can actually come in here and get this specific number. So the guy who created that indicator, his name is Mobius, he figured out a way to get this distance without actually coming in and getting this number. His workaround and this number don't always match. Usually it's pretty close, but it's not perfect. And especially on short weeks or holiday weeks, things like that, where we get a short day or we get a day off, it'll really screw with this indicator. So, it never hurts to just come in and validate sometime during the weekend after, 4:15 on Friday until Sunday at 5. As long as this number hasn't moved, then you can use it to validate the range for the week. It's plus or minus 104 at the moment, which, by the way, we're moving 100 points a day. This is saying that the entire range for next week is plus or minus 100 points. Again, another example of volatility. We're far exceeding the weekly expected move on a day-to-day basis. So one thing that I like to do on Fridays is measure the current week's range and lay that on top of next week's range and ask the question, are they pricing in more volatility for next week or less volatility? If the range is bigger, then there's more. If the range is less, then there's less. Right now, it looks like they're pricing in more volatility for next week than the volatility we had this week. It is worth noting that the weekly expected move held the line. We got into it Wednesday, tested it on Thursday. We're back inside the line now on Friday, at least so far. We're supposed to close inside this range 80% of the time. And sure, we miss once in a while, like last week. But on average, we're supposed to close in the lines. What I like to do to get that average, rather than counting back every single week on the chart, is I just use 10. 10 is a nice, easy number, and it's really easy to use it for percentages, right? I count back 10 weeks. How many weeks have we closed outside the box on Friday in the last 10 weeks? If it's more than 2, then we're not hitting our 80%. If it's more than 3, we're not even hitting our 70%. And that tells us don't use the weekly expected move for things like the weekly iron condor, the butterfly pens, things like that. NVIDIA's earnings is next week, and it's one of the biggest things that I can think of at the moment for why next week would have more volatility than this week. But here's the rub. Last NVIDIA earnings, Monday and Tuesday was really, really tight range. I mean, it was really tight. We moved like, what, 35 points up and down? Really tight range. So NVIDIA's earnings is volatility suppressing until we actually get the earnings. Then we're expecting some movement. We're still 1% above the 10-day moving average. We're below the sweet spot, but we're in it. So, as long as we're maintaining within this range, all is good in the world. We're not overbought. We're not overextended. We haven't moved too far, too fast. Even with this downside move of yesterday, we're already back to half of the move. So this is nothing, right? It's just a speed bump. Shock and awe. We're 2.37% away from the 10-week moving average, and we're right where we want to be. We are within this box, and I like it near the midpoint of the box, but anywhere in the box. If we're outside of it, yeah, it's getting a little extended, a little too much. And of course, if we're underneath it, we're under the 10 at that point. That's the 10-week moving average. We're doing good. Everything's fine. Over the last 5 days, energy is down 1.5%, and tech is down 0.5%, mostly thanks to yesterday's move. Everything else is still green in some fashion. Most of these are about 1% or near 1%. The bottom 3 are our defensive plays. The middle is the midline plays, and then the top are the risk on. Now, you could look at it as growth versus value. There's always that. A little bit of a rotation yesterday. If you look at how much things fell, staples fell, but not by very much, right? Utilities fell, but again, not by very much. The big falls were in, say, tech and consumer discretionary. Financials didn't fall at all, which is interesting. KRE was down for a bit. It was underneath that VWAP. But still, it held the line pretty good compared to the Mag 7. So that's what we have on the table today. A hurry up and wait scenario, a lot of economic events. You want to keep your eye on the clock all day today. Keep your eye on the news all day today. There's no best news site out there unless you've got some, something like Hammerstone or Hammersmith that's going to cost you a couple hundred a month. You want something that's free and does a really good job. Finance Juice. You can come here and get an account for free. You don't even need an account, but I would encourage you to get a free account so that you can use a filter. This is a news aggregate website. It'll get news from everywhere. And I don't know about you, but I really don't care what the hell MSNBC and CNN and Fox News has to say. All right. I don't want to hear it. So I take that junk off of my news feed. If you have a free account, you can use the filter and weed that trash out so it doesn't populate into your news. If you have a paid account like I do, you could turn on the voice. The voice will often give you data that shows up in the printed area. You'll hear it in voice sooner, or you'll hear it in voice and it never shows up here at all. So, having a paid account and turning on the voice lets you hear these things and other things. That way you're not even sitting there staring at the news. You just hear it. And it has order flow built into it, by the way. So if the ES starts to catch some flows, it'll start making this really funny noise and you'll know, and it'll get your attention and bring your eyes back to the chart. So watch the clock. Be careful, be safe. Have a good